All right. All right, everybody. Good evening. Welcome to the Hurley Investments Market View Commentary of June 6th, 2022. Obviously, you're probably expecting Kevin, and obviously, I'm going to be filling in for him tonight. Kevin has been dealing with a son that got in an accident and has been in the hospital. So he asked me to take over for the next week or so and take care of accounts and make sure you all have what you need. And that's kind of what I'm here for. Um, just to get right into it, we've got a market that is trying to bounce back a little bit and has struggled a bit this last week. We were both, Kev and I, hoping to see it kind of bounce back and get up to that 50-day support level, well, resistance level in this case. 50-day moving average resistance level, and it almost got there and it's kind of petered out this last week. Not really sure why. It's just lost a little bit of momentum these last few days. So everything as far as managing what we're protecting and what we're not was based around that. And for the week ahead, that's really kind of what I'm looking for, what I have to get protected, and what is just not going to make it up to those resistance levels and needs to get protection back on for a leg lower. But before I get into what we're doing and why, wanted to go over this big picture. I really liked this. It's kind of a shorter one by briefing, but their big picture commentary on the week ahead, or I guess the last week. He talks about the idea of cash is king and how credit unions and banks offer this great news about how savings rates are so much better and deposit rates, and you get better interest. But of course, the problem is inflation is so high that you're really just guaranteed to lose money if you're socking it away in CDs, money market accounts, high yield savings accounts, etc., etc. He goes over, he says, it's all relative. The new annual percentage yield that can be held on a high rate savings account at the credit union is, wait for it, 0.75%. Now, how about the high rate checking account? That's all the way up to 0.25. CDs, 1.5 annually. On a 1 year and a 5 year, it is 2.8% annually. And he kind of mocks, which is really fun to see, mocks the great news marketing that some of the banks send out in their mailers. How about how much money you can make in these low interest savings accounts. Currently, the year-over-year change in the PC price index is 6.3%, whereas the year-over-year change in the consumer price index is 8.3%. These are relevant inflation measures for savers because savers still have to pay for food and energy. Illustrated in the chart below are the real savings rates based on the credit union's offerings above using the consumer price index as a deflator. So all this is saying is with all these great savings rates, you are still guaranteed to lose in the long term 7 to almost 8%. Super duper awesome. Let's see. So he comes to the point that he talks about how pundits say that cash is trash. What they mean when they say that is that excess cash held at home where it earns nothing and excess cash held at banks where it earns a negative return on an inflation adjusted basis is not where you want to put one should put their money. I'm looking for where, okay, so there's also a capital preservation factor that helps a great deal psychologically sitting in cash at a time like this. So we're in a situation where it seems like holding cash on the sidelines or putting it into savings or, you know, one of the options that he argues is stupid up above. But we're also in a time of high volatility in our stock market, where if you put it to work there, that can be a dangerous place in some cases. But I like how he finishes this article off. These tough times won't last. They never do, although some stretches are a little longer and more challenging than others. When stock prices fall like they have been, though, investors with a long time horizon have the opportunity to use excess cash to accumulate stocks of quality companies. Basically talking about putting that cash on the sidelines to work. My favorite investor of all time, Warren Buffett, has not only made a living but a fortune doing just that, which is why he always seems to look kindly on bear markets. Successful investors invest in stocks for the long term. The average annual historical return of the S&P is close to 7%. You won't get that in cash, and the author certainly isn't going to get that with great news about savings rates at the credit union and holds his mortgage. So I like a lot of the things he talks about in here. What I don't like is an inflation adjusted basis of return on the S&P, historically 7%. You guys have heard this often talked about by both Kevin and I, that real returns in the stock market are not average returns. And he is talking about average returns, making the argument that, you know, if you have a good opportunity to put cash to work on a buying the dip mentality, which is certainly a good idea, what is stupid is the fact that real rates of return, again, are not average returns. You've heard Kevin talk about the story of a dollar, where if you invest your dollar in the stock market and it goes up 50% one year and the next year it goes down 50%, your average return is what? Some of you long in the tooth here will know the answer. I like to see a lot of new names. So for you, what is the answer? If you invest a dollar in your dollar in the stock market, and it goes up 50% one year and down 50% one year. What is your return? I should say, what is your average return? Yes, Kramer, I know you know the answer. That's your real return. Still waiting on a couple of you other guys and ladies. What is your average return? Going once, twice. So your average return is $0. Well, not $0, 0% average return. But what is your real return? It's going to underline. Where's my underline? Ah, forget it. Terrible with this. I'm still used to Microsoft, not Microsoft Word. I'm still used to WordPerfect. Old school. Your average return is, and Mr. Kramer got it correct, is a negative 25%. So if your invested dollar makes 50%, you're at $1.50, and then the next year loses 50%, it loses 50% of 150, right? Which brings you to 75 cents. And although you still have a 0% average return, your real return is a negative 25% loss. And it doesn't matter if you go down 50% first and then up 50%, it's the same math. So, again, I like the idea of what he's saying. Stupid to put your money in some of these savings accounts, you know, to some degree, unless you're looking to hold some of it on the side to buy the dip in some stocks. But what we do is also a little different. Again, I know I'm preaching to the choir for some of you, but you new folks need to hear this until you are just so darn sick and tired of it. If we can invest $1 and protect it, say it costs us 5 cents. Oh, I keep forgetting to put that in the right place. Bear with me, guys. So your 5 cents to protect $1, your $1 of one share, we'll say. We buy a contract for 5 cents to protect our invested dollar. So when it loses 50%, we have the right to sell our stock at $1. We paid 5 cents for that right. I'll say that a little clearer. So when it loses 50%, we can cash in and now take the difference there. It's trading at 50 cents and we have the right to sell it at $1. We now have enough to buy another share. $0.50. So now what's our cost basis? We now have 2 shares. Let's just roll this up so math is a little easier. Say it's more expensive. Two shares trading at 50 cents. We take our cost to protect, which is 6 cents, divided by the 2 shares we now have. And our cost basis is now, anyone want to tell me? 53 cents. So our 2 shares with our cost basis now lowered down to 53 cents. Because we have those 2 shares, all we need for this stock to be profitable is what? How much does the stock need to come up for us in order for us to be profitable? What do you guys think? Stock's trading at 50 cents per share. Our cost basis is 53 cents now. We lowered it from $1 down to 50 cents plus our 6 cents divided by 2 more shares. I know it's getting all of this math all around, but it's really fairly simple. How much does the stock need to come up for us to hit our break even or for us to be profitable? Abraham, Bill, Ida, you guys know this question. You know the answer. And our winner is William. The answer is 53 cents per share. So our break even is 53 cents. So what does this mean? All this means is that we don't need the stock market. We don't need to wait for it to get back to $1, for our invested dollar to get back to the value of dollar. That would require a 100% return at 50 cents in order for it to get back to $1. Would require a 100% return just to get back to break even. But if we can spend a little money to work like insurance on our invested dollar, well, if it loses 50%, now we have the right, that 6 cents gives us the right to sell our share at $1, which means if it's trading at 50 cents, we can now cash that in, the value of that insurance-like derivative. Now we have another 50 cents, we can buy another share. We can double our shares on a 50% drop. And we only need it to come up 3 cents to hit our break even. And when it gets back to $1, we have a hell of a return. When everybody else is just getting back to break even. All this is talking about is dollar cost averaging. And if you can use this protection to protect shares of stock before it goes down, or as it goes down, you can dollar cost average without having hundreds of thousands of dollars of cash on the sidelines, or for us to come to you as clients and say, hey, we need you to put a bunch more cash you have to work and risk in the stock market. We've already done it for you. So my long-winded way of saying let's do somewhat of what he's talking about. Smart to have cash on the sidelines if you're going to use it to dollar cost average, especially when we were at all-time highs. Always better to be looking to have cash on the sidelines on all-time highs so that you can take advantage of drops. Even if we're using this method of protecting and dollar cost averaging, cash still is king. What I would not do is do a 60-40 split bond to stock portfolio where you've got a third of, or not a third, a 40% bonds sitting in your portfolio where you are guaranteed to lose money because the interest rates are so low that inflation alone will cause you to lose money. Just like he's saying up here about savings, all of these bond funds in a 60-40% split of a portfolio, 40% of your portfolio is guaranteed to lose money. Wouldn't it be much better to have the cash on the sidelines to dollar cost average? Dollar cost averaging is way more important than having all of your dollars invested in something all the time. Let me write this in bold. Why would you do that? Why would you do that? My goodness. Why are people still doing this? Your guess is as good as mine, but I will not ever understand it. Yeah, maybe when stocks fall off and bonds go up, you could try and sell those bonds and buy low at dollar cost averaging your stock, but it really takes an active manager. The people that are doing these 60-40 split portfolios are not active managers, they're just passive managers that don't do anything. They charge you a percent, pretend like they're cheap, put you into expensive bond funds, which, aside from inflation alone, let's say there was no inflation, with a bond fund that's yielding less than 2%, percent and a half, 3% maybe, the fees alone are going to be closer to 4 or 5% anyways. These are companies, these mutual funds are companies, they have taxes they've got to pay, they have employees and office buildings, and you're guaranteed to lose money on all 40%, even without inflation. Why on earth, you might be asking, would a bond fund cost more than it's yielding in interest? Your guess is as good as mine. I don't know why anyone would want to put their money into something that they're guaranteed to lose money. I don't get it. Of course, with the stock side, you have a variable return. It goes up, it goes down, but at least we can have the chance of protecting. And of course, this scenario is fairly simplistic and doesn't always work out like that. They don't always go down 50%. They don't have to go down 50%, but any little drop we can make up, and any portion of that drop we can make up as profit. And the more of those little drops that we can make up with our put protection, the more shares we can buy at lower prices and accumulate more shares for exponential return as they head back up. This is the way, as the Mandalorian would say. All right, so I've kind of given you my thoughts. I can erase that. Any thoughts or questions so far on anything I've said? Keeve, you're an idiot. Stop telling us what to do. I want to lose money in a 60-40 split portfolio. Don't tell me how to live my life. Let me get some pictures of our stock market. our NASDAQ, they all kind of look pretty similar. Our Dow, Dow got a little closer to this 50-day moving average, that little blue line you see. But otherwise, they all fairly look similar. Let me answer this question after I post some of these pictures. Let's see if I can find them. So I want to know what you guys think. Where are our markets going to end up this week? We're going higher, lower, don't know, don't care. So this week, what I think, I'll say slightly higher. And really, the absolute only thing I am going off of is just this small difference in each of these. Of the distance that these markets have to go to hit that 50-day resistance level. It's gone sideways for about a week, but I think by the end of the week we're testing that 50-day. You can see it here, up at 42, 41 on the S&P. I hate that it says bullish. I'm not really bullish, to be honest. That's a little aggressive. I just think it's going to come up with a bit more and test that. Especially on this NASDAQ, got a bit more of a way to go. And this pivot point has been something that most of the stocks you'll see has kind of been settling on, trying to build a base up higher. So we'll see by the end of the week where things will go. I'm going to say, where will it end in June? I gotta say, I'm going to say up 1%. And really all I'm thinking about is all these stocks. Let me see if I can get some good examples. Apple might not be the best one because it's gone down the past few days. They typically go down a little bit after their developer conference that they had today. It's typical of it to run up before and fall off a bit after. Boeing comes up to this pivot point. It's been testing this pivot point, has some room to get up to a 50-day. Good. Disney, similar deal. I mean, they all look fairly similar, and you can tell that the market is dragging all this stuff around. Let's look at Ford. Another one needs to get up to 1450. Let's see. Facebook's probably a little different. Yeah, it's been going more sideways. Bank of America, another one. Got fairly close, but not quite. Let's look at JP Morgan. Come on. JP Morgan's doing a little better, but again, and it is above that 50-day, but a similar shape where it's gone up for a week and it's sideways for this last week. So I'm going to be looking to see if that happens, if it goes up to test that 50-day support level, resistance level rather. And then I'm going to be looking to get protection on as we have our rate hike decision next week on the 15th, where we'll want to have a little more protection to see if, just to be safe as markets react to another rate hike. You'd think it would be already priced in, but you just never know. All right. So that's what I'm looking at. Earnings. That's not earnings. Where are you? Here we are. Not really too concerned about earnings. Some food companies that might be interesting on Monday. Smuckers, UNFI, United Natural Foods. Don't really care about those ones. The 8th, we've got Campbell's. Not that this is going to be market moving stuff, but with all the inflation and all of that stuff, it'd be interesting to see. Nothing there. DocuSign on 9th. Little tech company. Stitch Fix, a little clothing mailer. Not a lot happening. Let's go to economic reports or calendars. Let's see. Here we are. This week. Tomorrow we have a consumer credit. I think I actually put these on the wrong day. Because we're on Monday. Tuesday, let's see. No, I didn't. All right, sorry to bore you. Tomorrow we've got consumer credit. Just to see what we'd expect to be good-ish. Health of our consumers. Let's see, Wednesday the 8th, mortgage applications. Wholesale inventories. Oil. Kind of important for our inflation with the oil. And then we have on the 9th, our natural gas and unemployment. Initial claims and continuing claims. And then our inflation readings on Friday. That could be a big one for obvious reasons. And that's this week. Any questions, thoughts, things that you guys are worried about, you want me to help you not be so worried about? I wanted to add this. I really like some of these articles by Howard Marks. He asks some relevant questions and some good thoughts on economics and some simple explanations of helping people understand. So I liked this one a lot, if I can get all of it for you. It talks about how cycles recur time and time again, and that our markets, sorry for me scrolling here, I'm sure it's annoying. I wanted to get to the top. It's a nice long article, so I'm only going to link one. He quotes Mark Twain, "History doesn't repeat itself, but it does rhyme." So looking back in history of what similar situations we might have been in and how they might be applicable today. It's never going to be exactly the same, but things might rhyme, be similar, that we can we can contrast and compare with and see what the future might hold. So that's a good one for you guys to read. I encourage you to do that. I'll see about getting it posted, but that's really it for me. Last chances for any questions. Appreciate you guys joining me. Again, sorry Kevin couldn't be here tonight. I am going to go ahead and cancel my Thursday morning webinar that I typically do. I felt that this one is typically more important, and I don't know that I would be suggesting a trade anyways with just the fact that we have that inflation number coming on Friday, the following day, as well as the interest rate hike expected next week. I think it would be a better time to just sit on your hands and see how things play out, see how the market reacts. And I don't know if I'll be back next Monday. We'll see. If I am, you'll know it then, obviously. But guys, is there any other thoughts or questions? I want to make sure anyone has time to type anything in. If not, thanks again for joining me, and I look forward to seeing you guys next time. Take care, guys.